top for sterling. IDA Global's view at the present moment in time is that the dollar downtrend is unlikely to be extended significantly. While the FOMC minutes were somewhat more dovish than expected, the market, I think, will sort of look at the bigger picture, and the bigger picture is that the Fed still wants to tighten in 2015. That includes a number of dovish members, and indeed, the way that we see the data panning out in the next couple of months, those expectations, if anything, are only likely to firm up. We can see a phase where US yields head for 3.05 in terms of 10-year US Treasury yields, and that can have a bootstrap effect on the dollar generally. The question is how to play it. If we pick a number of currencies, that there's certainly partly counterbalancing issues. Interestingly, sterling is perhaps one that we can look at. We would think that we could see a top in the 168 to 169 region. The chart's pointing then for a double top and the prospect for a breakdown to 162. Fundamentally, it is worth sort of mentioning that although the UK is likely to tighten along the same timescale as the Fed, the Bank of England are getting reticent about sterling strength. Additionally, some of the near-term inflation numbers are likely to be on the soft side, and more importantly, the UK is now running a fairly substantive current account deficit, which is a bit of a drag on sterling and will be a bigger issue going forward. Finally, the Scottish referendum, the polls are suggesting that we're going to see a close vote in September. The ramifications of a close vote are that the market can increasingly get nervous about a surprise victory in the Scottish referendum, which would be bad generally for UK assets because of the uncertainty that would surround Scotland leaving the UK. Against this sort of backdrop, tactically we think that there is an opportunity to sell sterling at the present moment in time, and we would look for 162 on a 2 to 3 month view. This is Mike Gallagher from IDA Global.